Hey guys, this is the TheoTrade Nightly Report for Tuesday, May 31st. My name is Doc Severson. I'll start out tonight by looking at the monthly, weekly, and daily charts of the S&P 500. Now, as I trawl the internet looking for information about markets, I am just absolutely inundated these days by emails and opinions saying that, wow, this time the S&P is really going to get rocked and really going to get crushed. In fact, that seems to be the majority opinion by people that are very knowledgeable pundits and very good writers, very intelligent market analysts, that here we go again. The market is about to die this time. This time it's really going to happen, and this is because GDP is terrible. We're in an earnings recession, and Janet Yellen's going to raise rates, and for all of these reasons, which so far the market appears to have shrugged off. So we're expecting it to have some kind of a different reaction. Now, don't get me wrong. I'm not a bull. I'm not a bear. I really don't care which way the market goes. I would honestly prefer that the market revisit somewhere down in this area again to give us some better value to be able to work from. I think this would be a great reset button if the market were to come down here again. And frankly, after January and February, this is exactly what I thought was going to happen. Was here we go. This is going to be a great little bear market. We're going to hit the reset button on the market. All of this excess froth that got thrown in here through quantitative easing and Operation Twist and whatever have you is going to get finally flushed out, and this market's going to be all back to itself again. Well, that's what I was thinking back in January and February, and here we are 301 points later, back to the upside, and as of today, the market once again has hit that third rail right up here at 2100, or in the spiders about 210. So that's one opinion. The shorter term time frame opinion that I'm also seeing is that this is turning into a repeat of 2015. So people are expecting the same thing to happen this year at about the same time frame as what happened last year. Okay, well, let's look at this in a little bit more detail. One thing that we know for certain is that tops are a process, and this is what we saw last year at this time, was that a lot of chop up and down, just didn't get anywhere, and all of a sudden fell off the cliff. This is the true definition of a trapdoor move or a waterfall decline. And then from there, nice higher low, market rallied like crazy back in October, November, and we got several weeks of chopping around before we got version 2 of this, which was another waterfall decline. Okay, so people are looking at this and saying tops are a process, bottoms are an event. Great. Here we go. Here's another tops a process. We're going to have the same repeat. We're going to be down here at S&P 1800 again. Well, if we truly objectively look at this chart and say, okay, what's different this time? I mean, what's different this time versus all the other times that the price tried to sell through 1800 and were unable to do that? And now we have the same kind of event happening up here at 2100, where the price is unable to get above and beyond that. So we're stuck in this 300-point range. But what is different this time versus the previous times? Well, I did find something that is a little bit different this time around. This is a chart of the symbol SPX A200R, which is the S&P 500 percent of stocks above 200-day moving average. Okay, so kind of obscure indicator, but makes sense if you think about it, because the 200-day moving average is kind of a delineator between bull and bear markets. If a stock is above the 200-day moving average, or its 200-day moving average, then it's generally presumed to be in an uptrend. Conversely, if a stock is below its 200-day moving average, then it's generally presumed to be in a downtrend. So think about this. Here's the beginning of 2014, here's 2015, here's 2016, and think about the price of the S&P in 2014. Certainly it rallied and then dropped here, and then rallied to new highs. So basically what we saw during this whole period was the S&P dropping and rallying again into the spring, midsummer of 2015 was really the high watermark there. Now, what happened to the number of stocks that were above their 200-day moving average during this time? It actually dropped. So it peaked out here in 2014 at about maybe 85%. And then by the time we got to August of 2015, right before that waterfall decline, we only had about maybe 55% of the stocks in the S&P 500 trading above their 200-day moving average. What's going on here? I mean, here in August, we had the price very close to the all-time highs. It was right up near 2100 before the price fell off a cliff. So it was not that far away from the all-time highs. In fact, it was just down a little bit from that, right? So what we had happening during this entire time was we had sort of an underground bear market. We had an underground bear market going on with the stocks in the S&P 500. Yet, because of the way that the S&P 500 is weighted, we had just a few stocks, a few behemoth stocks that were pulling everybody else up higher for the entire index. And so this tends to give sort of a distorted view in terms of what's actually happening versus what was happening under the hood of the S&P 500 index. And so, of course, yes, we had a nice bounce in the fall and right back up to 2100 again. But that, again, was only at about 55%. So that was just a bear market rally, again, engineered by just a few stocks that decided to rally like crazy during the fall. So what's different about this move that we've had since around the February timeframe? Well, now we're back up to about 75%. This is a game changer. This is very different. We now have 75%, or approximately thereabouts, of stocks of the S&P 500 above their 200-day moving average. So basically what we're saying is that 75% of the S&P is in a bull market. This is very, very different from the 55% figure that we had here last August and in October, November, December or so, right? Big difference before we had these drops. So for those that are saying, what's different this time? Why aren't we going to see yet another sell-off from 2100? Well, I would point to this indicator that shows that there's a little bit more unified strength of the S&P that's from this bounce from February. And a lot of this has to do with the search for yield that's out there. Really, just about anything that pays a dividend is being accumulated like crazy these days just because of that fact. So let's go back to the current chart. Where does that leave us? Okay, back to the S&P here, monthly, weekly, daily. Where that leaves us right now is the price is currently in a larger range on the monthly chart from 1800 up to about 2100 or 2100 and change, right? So just a little bit over 300 points in the full S&Ps or 30 points on the spiders. But within that larger time frame range, we also have a smaller time frame range that we've seen over the last few weeks, really since early April, okay, to the May time frame. Here we've had a move about from 2030 up to about, again, that 2100 level, or in this case 203 up to just a little bit over 211, around 211 or so on the spiders. So larger range, smaller range. And so what we want to do is we want to see if the price is able to break above this range, and if it does, we have to take it seriously. We're not just going to negate our view on that range just because we don't want it to happen, right? So we have to take that seriously regardless of our bias. What we can also do is we can look to take trades within this range until it proves that it can break out of its range. Right now, I personally think that the price will get stuck within this range from 2030 up to 2100 or so for the next couple of weeks until we get more of a reading in terms of what's going to happen with the next interest rate hike. So what we could do is, since the price is very close to the top of this range, we could trade a bearish short-term spread against the spiders, looking for the price to go somewhere near either halfway down or maybe lower on this range. And the way that we could do that is maybe pick something about 30 days out, give ourselves enough time for this to move. I would pick the weeklies over the quarterlies for that. And looking at the spiders, and we're not going to have any problems with open interest and volume on this one. As you can see, we got plenty of volume, plenty of open interest to be able to support any trades. And we, of course, have those great tight spreads that the spiders provides. And so what we can do is pick one option in the money, buy the option in the money, sell the option out of the money. So maybe in this case, maybe 209, 211. And we're going to buy this spread looking like this. And again, 209, 211. And so that's going to be about $1. So we're risking $1 to make $1 on this trade. And we don't look for the entire dollar. Usually about 50, 55% will do it on these trades. And again, I think we have a high probability of the price coming down at least a few points in the next few weeks. Look at the expected move for this one. It's actually about 7 points, plus minus 7 points. So do we think that we're going to have a move 7 points to the upside by the first week of July? Okay, unlikely, but it certainly could happen. Could we also see the price revisit the bottom of the range down here at about 203? Certainly could happen by the first week in July. So my parting thought here with tonight's report is leave your bias at the door regardless of what happens in the next 2 weeks, because I think what will occur with the market is going to defy logic, and the market will always move in a way so as to express the greatest amount of pain, or to inflict the greatest amount of pain across the widest cross-section of participants. That is what the market's job is, and that will be its job in the next 2 weeks. Thanks for listening, guys. Have a great evening. We'll see you tomorrow.